So I've been 100% equity for probably the last 2.5 decades. I have seen my portfolio falling anywhere between 30 to 50% at least 4 times.
So Ashish, you were telling me off the record that you have this very interesting way of putting money into equities.
I keep almost 6 months of my expenses in savings bank account. Sometimes it goes up to 8 months. Bigger the corpus, entire objective becomes more preservation.
The ones who have built a huge startup, who is making money through listing their company, they're relatively young people and have a lot of money. How do they manage their own money?
Generational wealth, right? That wealth is a little more conservative and more tilted towards preservation and traditional asset classes like debt, equity, gold, alternates, so on and so forth.
You happen to mention that you also help your parents manage their portfolio, but you have invested 100% of their money in equities. Generally, older people, they tend to stay away from equities, right? So what is the logic behind that? Welcome to the latest episode of Mint's Guru Portfolio. Today, I have with me Ashish Shanker, who is the MD and CEO of Motilal Oswal Private Wealth. They manage 1.3 lakh crore in assets, and today he is going to tell us how he manages his own personal portfolio. Hi Ashish. So Ashish, can you tell me how your personal portfolio is split? I know your firm manages money for people who have at least 2.5 crore, but I want to know from you how you manage your own portfolio.
Yeah, so Shashin, hi, happy to speak to you again. I think we spoke about 3 years back.
2 years back.
2 years back, that's right. So I keep my portfolio very, very simple, as you know, right? It's 100% equity because I'm a firm believer in India and the future of companies in India and the stock markets. So I've been 100% equity for probably the last 2.5 decades, and it's working out well for me.
Actually, 100% equities sounds very easy, but I mean the kind of volatility the markets have.
Right.
In the past 6 months, market has been very volatile due to Trump and everything. So why did you decide to put 100% of your money in equities? And also, how is this 100% split between different instruments?
In wealth management, also, we say that there's no common size that fits all, right? Everybody is different in their outlook, temperament, nature, ability to stomach volatility. I think I've been a very avid follower of stock markets right from my college days, and I've been attracted to equity markets. One of the reasons was I believe that equities, at least in India, uh, can compound the fastest over time. Over the last 2.5 decades, I have seen my portfolio falling anywhere between 30 to 50% at least 4 times, right? So once you get used to that, you get immune to volatility. Again, I mean, to be honest, it's not easy, and I don't recommend it for everybody. I mean, we work with many ultra rich families, and typically we follow an asset allocated approach. And I think that's a sensible thing to do. But it's just that I'm very comfortable with 100% equities in my portfolio because I do believe if you have good companies or good funds in your portfolio, then over a longer period of time the predictability is very, very high. Shorter term, of course, you have to be prepared for vagaries of the market and accordingly, have enough buffer.
Actually, you told me 100% of your portfolio is in equities, but I just want to know how much of it is in India.
So at the moment, Shashwant, it's 100% in India because I do believe India still continues to offer a lot of growth opportunities. And I understand India. I mean, I do understand global economics and what's happening in other markets. But I think, being here in India allows me the unique ability to understand companies, what's happening around me far better.
Ashish, I think there is a lot of this one expert who is giving a counter narrative, right? Which is the Indian markets have become very expensive,
Right.
whereas the global peers and similar companies are offering at a very low valuation. Why do you think 100% in India, where the valuations are slightly expensive? Why do you think that's a good idea?
So to be honest, I'm not averse to having allocation globally. It's just that I have not done it. A lot of our customers do it, and we do offer options as well for them to diversify globally. I mean, will I diversify globally tomorrow? There is a chance I will diversify globally tomorrow. But having said that, it is not because of valuation reasons, right? These narratives on expensive, etc., are very short-term narratives, right? I mean, someone says India is expensive. I mean, expensive from a 1 year point of view, 3 year point of view, 5 year point of view. I mean, as you know, I've been invested in equity for 25 years, and hopefully, I can remain invested in equities all my life, right? So, if you take a slightly longer term view, it doesn't matter.
Ashish, let's say your portfolio is 100 rupees, then where have you allocated this 100 rupees? You have told that it's in equity,
Right.
but how much is in mutual funds, AIF, PMS?
See, broadly, about 80-85% of it will be in direct equity, and that's also a function of the fact that my ESOP is a large part of the portfolio holding, right, which is nothing but direct equity and the Motilal Oswal stock. Remaining 15%, which is essentially the portfolio that I've built through my savings, that is predominantly in either mutual funds or few AIFs. Got and yeah, that's it.
So, Ashish, you were telling me off the record that you have this very interesting way of putting money into equities.
Right.
Like nowadays, SIPs are very popular, and
Right.
literally everyone are, especially the salaried people are doing SIPs. But you invest 100% of your money in equities, but you have never done SIP in your whole investment journey.
Right.
So what's the logic like, and how do you go about
Right.
investing money?
So to clarify, look, I have not done SIP in the traditional sense, which is SIP is basically you choose a particular date, and on that particular date, a certain amount goes into the funds or stocks of your choice. But if you look at the last 20-25 years of my savings history, I have done SIP in a way, in the sense that whatever is the surplus every month, I push it into equities. Right. So it's not an SIP in the strict sense that you choose a particular day, and because what I've figured is there are some months where I have more left to save, and there are some months I may have less left to save. And I don't have a problem with the discipline. See, the moment you do SIP, you become disciplined also. I don't have a problem with that because I'm reasonably disciplined. So whatever is left over of every month, I put it into equities.
Actually, so, what's the exact meaning of over? I mean, how much money do you want to have in your savings account?
Right.
And after that, whatever money is surplus, you want to invest that money
That's
into mutual fund. But what is this number that you want to maintain in your
right.
savings account?
So, I don't like to be restricted on my expense part because, some part is going into savings or EMI. I mean, my debt is practically zero. I don't like having loans. What typically happens is after all the expenses are taken care of, or broadly, I have a sense of the expenses, I push the remaining of it in equity funds. Broadly speaking, it would be anywhere between 10 to 20% of my income over the years if I analyze it. That's the kind of savings I've been able to do. And then, of course, whenever you get your annual, whatever bonus or incentive or payouts, then again, you would get a decent lump sum to push it into savings. And, to your point on being 100% equity, one more, approach that is different for me is, I keep almost 6 months of my expenses in savings bank account. Sometimes it goes up to 8 months. And the reason I do it is my savings is all 100% equity. So if there were to be any market volatility, for me to be able to withstand that, I feel that I need to have so much liquidity. And that also gives me the ability to take more risk.
So, in simple terms, whatever expenses you need for 6 to 8 months, you maintain in your savings bank account.
That's right.
Anything extra in terms of bonus, in terms of money coming in there, you invest straight away in uh, equities and mutual funds.
That's right.
Ashish, you were telling me this story, very interesting story, wherein you bought the Mumbai table tennis team. So, is that the investment, or is that kind of like a fun
So
activity?
this I've recently done, and essentially, I used to be a state level table tennis player, and I am very passionate about the sport. So this is a new league that has been started by the federation. If you've heard of UTT, Ultimate Table Tennis, they're the same people who have now ventured to start a league at a state level, right? So because I'm so passionate about the sport, me and a friend of mine co invested in the Mumbai team. I mean, investment will be a wrong word to use, to be very honest. I'm not really seeking too much of returns from this. It's more to support the sport.
So, this is not part of your
No, I don't
investment
consider it
portfolio.
part of my portfolio at all. It's more a expense, I would say, a passion expense.
So now, Asha, I want to come into this related point, which is how do rich people manage their money, right? Because you run this company, and your company takes in investment of at least 2.5 crore. So people having,
Yeah.
less money than that cannot even participate or invest through your company. So you deal with a lot of rich people. I just wanted to understand how they think
Right.
about money, how they think about investments.
Right. So I think the first discussion that we have with anyone is on how do you want to allocate, how should you allocate your assets, right? Clearly, if somebody is in a build-up phase, in the sense that young professional in their 40s and looking to invest their money for goals which are much later in life, then you are more allocated towards equities, and within equities, depending on the size of your portfolio, you would have funds or AIFs or stocks or PMS, right? And you'll have some debt and some gold. But if I move towards ultra rich, let's say ultra rich in India is defined as somebody who has a portfolio of 25 crore plus. But then again, you have a lot of ultra rich families who are, let's say, in excess of 100 crores, right? So the larger the portfolio, the way it changes is the objective moves more towards preservation of capital, right? So typically people would have a balanced portfolio or would have a slightly conservative portfolio. So typically equity would be 30 to 50% and rest will be debt and gold and certain other alternatives. Uh, as the size of the portfolio increases, the share of alternates in the portfolio increases, because then you're able to do things like structured debt, you're able to do things like private equity, you're able to do things like co-investing, you're able to do certain international investing. It's all a function of corpus, because the minimum ticket size for some of these alternative funds is 5 crores. So hence, if you have a 10 crore portfolio, then you're more restricted to the traditional avenues like a mutual funds, PMS or an AIF. The moment, or you can buy some bonds. The moment your corpus becomes in excess of 25 crores, move towards 100 crores, then you can actually build a meaningful portfolio of alternates, right? So that is how the color changes. But generally, the bigger the corpus, the entire objective becomes more preservation.
Ashish, I was just wondering, nowadays in the current scenario, there are two kinds of REITs that are coming up, right?
Yes.
Not just two kinds of, but I have two kinds of people in mind.
Yes.
The ones who have built a huge startup, who is making money through listing their company. They're relatively young people and have a lot of money. How do they manage their own money? How do they want to manage
Yeah.
their money compared to people who are in a salary job or who have been having huge amount of money from generations?
Yeah, so that's a very, very interesting and a good question, Sachin. Basically, what we've seen is that if I may call it generational wealth, right? That wealth is a little more conservative and more tilted towards preservation and traditional asset classes like debt, equity, gold, alternates, so on and so forth. But a lot of the people who are now creating wealth because of their own startups, right, are actually investing back in that ecosystem, because they somewhere have the feeling that hey, this is the ecosystem which has contributed to me and I want to contribute back to the ecosystem. Plus, there is the belief, because you've seen wealth getting created for yourself, that this ecosystem will also enable me to create a lot of wealth into the future, right? So they may keep some money aside, some liquidity aside, which will go into traditional things like mutual funds, etc., so that they have some liquidity. But they are more than happy to take risk and invest it back in startups. So you see a lot of these entrepreneurs typically in cities which have a startup ecosystem, like, to give you an example, Bangalore, Hyderabad, Pune, Gurgaon, or for example in Mumbai, something like a Powai would be an equivalent of Gurgaon, right? So yes, you see a very different risk appetite.
So, Ashish, for your own personal portfolio, how do you balance this? There is one side of the equation where people invest in, private shares, which
Yeah.
have a lot of room to grow, where you're taking a lot of risk. Whereas in the other extreme, and people are very conservative. Obviously, you don't have any that portfolio, but do you have any allocation in startup
No,
kind of
so last
companies?
year I have invested in a couple of unlisted companies. I mean, actually, one very negligent, but one unlisted company, because I feel that this is a company which is in the right industry with a large runway of growth. And our funds have also invested, so there was a co-invest available, so that's how I could decide to allocate there.
And can you share us a little bit about this company? What does this company do, and why are you,
So I think what is happening, Sachin, is that because a lot of private equity money is flowing into India, either through domestic funds or global funds. Many companies which are in very exciting sectors are choosing to remain private for longer because that allows them the flexibility to invest and grow faster. So to give you an example, sectors like internet consumer sectors or any digital platforms, right? We have a few listed players. I mean, for example, the biggest in terms of market cap is Zomato, right? Zomato was unlisted for a very long period, and these are all new age sectors with long runway for growth. So if you have to invest in these kind of sectors early, then if you you do get an opportunity in the unlisted space.
Ashay, I want to end this interview by asking you this very interesting question.
Right.
So we were talking backstage, and you happened to mention that you also help your parents manage their portfolio,
That's right.
but you have invested 100% of their money in
Right.
equities.
Right.
Generally, older people, they tend to stay away from equities, right?
Yeah.
So what is the logic behind that, and how is it going on?
Logic is simple. Look, I guide them and they decide. But we had this very interesting conversation 8, 9 years back, and they were asking me how should we manage our finances. I said, look, I'm a big believer in equities, and I do believe even because they had a corpus that would allow them to do that. I said, even you should be fully in equities because equities compound at 10, 15%. Yes, if there is any volatility in between, it was my parents, so I could tell them, look, I'll cover the shortfall, right? So that safety net they had. But I think we did it 8, 9 years back. We broke all the fixed deposit and put it in equities, and it's done extremely well for them. So the portfolio in the last, I think, 8, 9 years would be up anywhere between 5 to 6 times, which in FDs, I mean, you would have been happy if it would have barely doubled, right? So they have a much bigger corpus, and they like to invest in stocks. So now the dividend income itself is taking care of their expenses. So really, the volatility in the market doesn't impact them. So I do believe beyond a certain threshold of a corpus, you can do that, but they probably got that conviction because of me as well. I wouldn't advise this to everyone. But just one thought I wanted to leave, because there is a lot of traditional thinking on asset allocation. I do believe after a certain corpus and after a certain age, you can become very aggressive because most people cannot consume their savings. So actually, you're leaving the portfolio behind for the next generation. Then your time horizon is actually much longer than you think.
Ashish, I just wanted to know what about your own retirement? I mean, a lot of
Yeah,
people are now talking about
yeah,
fire and how are they
yeah,
going to retire.
yeah,
So, do you have any corpus in mind?
yeah.
And
No, I think last time around we had spoken about this, and I think it became a little controversial. But I still maintain the same thing. I think fire is overrated. I mean, and again, each to himself. If someone wants to retire early, I mean, each to themselves. But I believe in this age of intellectual we are in the age of intellectual professions, right? This retirement thing was made way back when you had the factory culture, right? So you physically get tired at a certain age and you want to hang up your boots and rest your bones, right? But today, all of us are sitting in nice offices. Yes, we do travel, but most of the work is intellectual, right? So if you're mentally active and again physically healthy, then you can work all your life. I mean, just to give you an example, Buffett has retired at 95, and that too, he stepped down from the CEO role. I'm sure he'll continue to be active on the board and as a mentor. So people have to think a little differently, and people will live longer. So this whole thing of retiring and having a certain corpus and that'll be enough will get challenged according to me. In terms of retirement corpus, I think I had guided this in another interview that I believe whatever is your monthly expense 300, 350 times of that is a good corpus. If you wish to retire, you can retire
Of
at that
the
corpus
annual
of the monthly income.
of the money.
300, 350 times of your monthly income.
So if someone
Uh,
is earning 1 lakh per month right now,
Right.
and they should be having 3 crore at least.
That's right. Absolutely. In my case, I think I've already achieved that number. So really, I'm looking at maximizing wealth.
By the way, guys, there was one article yesterday, and Warren Buffett said he will, in fact, continue coming to the office
There you
until
go.
he's active. So
There you go.
I hope actually you also continue till 94, 95 in Motilal Oswal and build the
I
next.
hope so. If
About
you stay healthy. So I think health is something that one should focus on and take care of it very, very properly.
Thank you so much, Ashish. Thank you so much for joining me.